Hi, I'm Peter Rose, founder of Longwood Currency Trading. If you're going to trade currencies, you're going to lose. You're going to play poker, you're going to lose. Anything you do, you're going to lose until you develop the skill. So if you're going to lose fast and lose small. Let me give you an example of that. Not to get off the trading, but watch this. All right, so there's a picture outside the door. You can see how cloudy it is. Well, it's foggy. We don't call it clouds. We're up on the mountain here, and it's foggy, and it's raining. And you can hear the water dripping off the edge of the thing. So take a guess now as to if I was to go outside and run up to that rock wall in the rain. What do you think I'm going to do? I'm going to come back fast, and I'm going to get hit with as little rain as I can. Make sense? Good. Right. All right, so I decided to come in out of the rain fast and didn't get wet. Well, why don't we do that in our trading? What's wrong with that small loss? That small loss is so painless, and it gives you the ability to have more dry powder. It gives you the ability to try that trade again if it flips around and goes in your direction, or you could flip in reverse and go the other way if you were proved wrong and it goes quite a ways. How far do you want to set your stop out before you're shown that you've lost? If your win-to-loss ratio is not really strong yet as you're getting started in your trading, and you may not have a very good average win value, then how do you feel you're going to win the game by giving yourself a 20 or 30 pips stop when you're wrong? Well, let's put it at 20, which a lot of the day traders do. To give price room to breathe. Really? If you hit that 20 pip stop 6 times in a row, just out of happenstance that it's not your lucky time, that's a lot of pips. That's 120 pips. Would you let your price run against you 120 pips? You go into your entry and you let it run 120 pips against you? You probably wouldn't do that. So why take the chance on the statistical probability that you're going to lose 6 trades in a row at 120 pips at 20 pip stops? Why would you risk that? That's what I always base my decisions on. It's held me up pretty well, and when I ignore it, I take a beating like you wouldn't believe. I can lose someone's year's salary pretty quickly when I'm not following my rules. I look at my entry analysis with risk management at the forefront when I'm thinking rationally, and Ed, the little bridge troll that sits up here on my left shoulder, isn't whispering in my ear to do stupid shit, and I'm following my rules. What I say to myself, the first thing I'm going to say to myself in my risk management entry analysis of that price action at that time is, if I get involved in this, I may lose. But is the situation unclear that if I was to go in and get out and go in and get out and just keep banging away at that until I got it right, could I conceivably lose 6 times in a row? If that's the case, I'm probably not going to take the trade, because that's the same thing as saying, well, I'm going to let that run, 120 pips. I just won't take the trade. Or if I think there's a reasonable probability, I'll just wait and let price go in the direction that I think it's going to go in. What difference does it make if I set a short stop or a long stop if they're each going to get hit if I'm wrong? And what's the likelihood that I'm more solidly wrong when I'm wrong than I am when I think I'm right? Quite a bit. And so in my mind, if I'm going to lose, I want to lose right away. I want to know right away. And I don't want to lose a lot. I don't want to have a high volatility situation and know right away, but lose 20 pips because it went too far. It's like going out in the rain. I'm not going to go out in the rain if I don't have some particular purpose to go out in the rain, or I think, well, it's not too bad. The rain that we're seeing today was just a drizzle. But right after I turned around and started to come back inside, it got a little bit heavier. So if I would have walked out the grass up to that rock wall and said, well, it's raining a little bit harder now, but I'll continue to walk up to the rock wall, I'd come back soaked as a dog. Why? I'm getting wet. Why should I get even wetter? Even if the rain doesn't go any harder, I've got to go that distance. I've set that long stop. I got to go up to that rock wall and do what? Pull weeds in the rain? Why? I'm going to very quickly turn around and come back. I'll try it again later when there's no rain. I mean, it makes great sense, right? Now, folks will argue with me that, you're taking an 8 or 10 pip stop, and that's just crazy because you're going to get hit all the time. Yeah, it does, but I've got a good win-to-loss ratio, so it doesn't matter if it gets hit, a couple of 3 times while I'm trying to figure out why my trade isn't working. It's a probing point. You're never going to go in and enter a trade and the thing is magically going to go up for you. That usually doesn't happen. You're usually going to have some kind of a fluctuation. You're losing the spread as soon as you put the trade on. Look at your trading platform. You put that trade on, you automatically are 2 pips down. If your broker's spread is 2 pips or a pip and a half, you're 3/4 of a pip, you're the full spread down because you're going in and you're going to have to come out. So you're 3/4 to a pip so down just placing the trade. You're a loser just placing the trade, just like you're a loser if you buy a brand new car and drive it off the lot. You drop 20% on the value of that car. For regular cars, maybe not for a high-end Mercedes or a McLaren or something that are high-end cars. Those tend not to appreciate, but appreciate because they're assets many times in the right hands. Regardless of that, wouldn't you like to know if you're wrong? If you get on a bus, wouldn't you like to know right away that the bus isn't really the route that you need to take? Wouldn't you want to know that right away? And wouldn't you therefore get off the bus right away? But look, guys, look at the nature around you. Look at the world around you and how you conduct yourself. I'm going to put that down or I'm going to spill it. And how you conduct yourself safely in nature. Are you going to feel stupid about yourself and kick yourself all over the place because you tell the bus driver, hey, this isn't the route. You stop the bus. I got to get out of here. Or get off at the next closest stop. Are you going to beat yourself up over that? No, you're going to thank your gods for getting you off that bus because now you get on the right bus. So you got to look at this loss a different way. The loss doesn't hurt. It's hanging on to the loss that hurts. The loss doesn't hurt because you ended it, and now you can do the right thing. You try it again. So don't get scrambled up in your trading. That's why having a mentor or a coach or somebody to work with you on this stuff is so critical. It's so important. I never had that. I thought with all my background in math and physics and real estate and all the other crap that I had done in my life that I would be able to figure this out and be successful. And I knew I was going to have to learn the mechanics, so I'm watching the videos like you all do, and I thought, well, this is the straight scoop. It's not the straight scoop. Half of them are lying to you. They're full of crap, and the rest of them don't know how to teach. Whether they do it or not, they don't know how to teach. They give the credit for their setup on a Bollinger Band. I mean, I'm sorry, but you got to think for yourself. And if you don't know how to structure that thinking, and I'm pretty well structured in my thinking, and I looked at all this stuff and I just, oh man, I have to give this up. I got to get out of that. I've got the skills to do that kind of analysis. I was a software engineer for 33 years, and I'm in real estate for 40 years. And fortunately, I got a bachelor's degree in physics. I know how things work. And I stepped back from the currency market, and I looked at the market as for what it is, not for what was being projected at me through all the information that's out there. There's too much information out there, and I got wrapped up in that. As competent as I am, I fell for that. So if I can fall for it, you know, look, just be leery of that. You have to step back from the thing. What is the market? What's going on here? And particularly in the currency market, it's all about order flow. In the stock market, it's not order flow. It's order flow is the result of something else that's characteristic of the stock market. Order flow is everything in respect to the currency market. The currency market is different. Though you trade it with the same type of rules as you would if you're trading gold or old tires or real estate or stocks or commodities or whatever, it's a whole different market. Currencies are completely different from all the other investment vehicles that are out there. And the reason for that is it's a zero-sum game in its true fashion. I've described that on other videos, don't want to blame you, because what I'm talking about here is that if you are picking currencies to trade, it's easier to learn how to trade currencies, and trading the currencies is far simpler than anything else. So it's not hard to learn currencies, and it's not hard to trade currencies, right? It's easy to learn how to do it, and it's simple to apply the rules, where if you're doing stock trading, it's not easy applying all the stock rules and all the different things that you have to know and you have to look at. Currencies is really straightforward. It's very simple. You're only trading based on two pieces of information. That's all you need. And those two pieces of information are wrapped up in what we call the price. Because it's the ratio of the one currency pair divided by the other one. That's what the price is. I don't know, where did you think the price came from? I've lived in the city. I was born in Chicago, and I know city folks and stuff. And I'm living in the country now. I live up on a mountain, retired up on a mountain, 2 miles up a road on this mountain. And you laugh at the city folks because they think that the chicken comes from the frozen food counter at the store. Up here, there's still folks that are growing chickens and whacking their heads off, and that's where the chickens come from. Where do you think the price comes from? It comes from, in currencies, economies of the two different countries and how well those economies are doing. And you don't have to understand any of the economics of it. All you have to understand is what happens when those economies change. In one case, it'll make the currency pair go up, and in another case, it'll make the currency pair go down. And so, if you're in a trade, it's going to do one of two things. It's going to go up, let's say you're long, and it's in your favor, or it's going to go down, and it's against you. If it's right at entry, you got to be hyper-focused on how far you're going to let that price run against you. If you've got into a trade and the position is run 10 pips, and it turns around and comes back 8 pips, do you necessarily need to get out? No, you've still got 2 pips of profit. If you got out, you'd have a profit. Your stop is, maybe your stop is at entry, or maybe you've brought your stop up to 5 pips, so now you're gonna wait 7 pips. But why? It's come down from 8, it's come down 5 pips already. What are you gonna do? You're gonna wait another 5 or 8 pips in order before you stop out? No, but at least you're gonna make some money. And I did a video the other day where I was talking about the benefit of just making 3 pips. It's 0.3% per $1,000 at risk. I mean, if you're trading a mini lot, 3 pips is $3. If you're trading a 10 lot, it's $300. I mean, 3 pips is a lot of money in the currency market. So why would you want to let that run against you? Because it's a lot of money. If 3 pips is a lot of money going in your favor, if you did that all the time, if all you could get was 3 pips, you'd be in great shape. But if you constantly took a 3 pip risk, it would be the same thing. It would be way too much money added up over a long period of time. But that one time that you're going to take that hit in relationship to all the times that you got it right and it's going to go in your favor is a very small price to pay, not to screw up your whole account by letting the thing run 20, 40, 50 pips against you before you go, oh shit, now I'm screwed, I'm 50 pips down. Well, it'll come back and now it's 150 pips away from you, and you're in the same situation as if you took 6 20 pip losses. You wouldn't do that. You would want to avoid that. So don't take the 120 pip loss. If you're going to trade currencies, you're going to lose. So lose fast and lose small and live to fight another day. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.